So that's the end of my presentation. And the next up is Clark. So Clark's a senior manager. He's a CPA with BDO. He operates out of Revelstoke, but also covers this territory. And how long have you been with BDO?
I've been in Revelstoke for 3 years now.
Okay, so he's a senior manager there. So I'd like to welcome Clark to Verse.
All right, thanks Scott. Welcome everyone. How's lunch? Good, excellent. Little technical assistance here. So yeah, I live in Revelstoke, reside in Revelstoke, but I work also out of our Salmon Arm office here with BDO. And when we were throwing around the ideas about what we could present today for our lunch and learn and what might be useful, somebody mentioned taxes, and I said I really don't want to force anybody to listen to tax. So I am going to throw a little bit of tax in here, but really my presentation is about planning and the importance about planning ahead and planning for your sale. So how do you plan? What is a proper structure before you sell? And even beforehand, even before you might be thinking about selling, what kind of corporate structure should you have in place to take advantage of some of the tax incentives? So we'll go through some of those things. So again, we're going to talk a little bit about selling your business through an asset sale versus a share sale. Talk about the capital gains exemption because that's a very good tax incentive. And then just to look at possible way of an efficient corporate structure that we use with some of our clients. So just my disclaimer here, general tax knowledge. So if you need tax advice, please seek out your tax advisor, but this is for general information. So what is an asset sale or a share sale? So what I'm going to talk about today has to do more with individuals that own a corporation. If you're a sole proprietor and you're operating your business through a sole proprietorship, there's a few less, let's say, planning ideas or opportunities through a sole proprietorship, but one of them is, that I would just throw out there, is if you have a sizable sole proprietorship business, maybe thinking of doing a corporation before you sell, that could be a planning opportunity. So what is an asset sale? Well, an asset sale is when you sell your business, when you're selling the actual assets out of your corporation. So that's going to include, your AR, your equipment, property possibly, as well as your goodwill. So all those assets you're actually going to sell, the corporation is going to sell those assets to your buyer. On the flip side, a share sale is when you actually sell the entire corporation. So you're turning over the share certificate, and they're going to run and own that corporation, and that's what they're going to. The equipment and the AR and the property and all that, it's going to sit within the corporation, and that's what they're going to take is the corporation. And in an asset sale, you will actually retain the corporation. So I'm going to go through a couple of advantages and disadvantages of each of these from a tax perspective, instead of throwing a little bit of tax. So an advantage from the asset sale. So this is from a seller's perspective, and really there's not a ton of tax advantages from selling your assets. But one of them is if your business has incurred a bunch of tax losses over the years and you have those tax losses carrying forward, you may want to consider not doing a share sale. Because ultimately, if you sell your assets and you sell your goodwill and whatever income and capital gains you have on your company, you could use those tax losses that are carrying forward to apply against that income from the sale of your business. So that would be one opportunity for an asset sale, but there's a few more disadvantages. So one of the things, when you sell your assets or your corporation, you're selling individual assets, and individual assets that you sell may have different tax treatments. So if you sell your property, there will be capital gain there. If you sell equipment, you may have regular business income coming in. There's different tax treatments, which could result in additional income or gains. One big thing that I want to bring to everybody's attention is goodwill. When you sell a business, typically there's a component that's goodwill, and it can be significant. Prior to 2017, when we sold goodwill, it was a capital gain. So a capital gain is 50% taxable. So about $100,000 worth of goodwill, 50% of it, $50,000 is taxable, the other $50,000 is not. And before, that capital gain was taxed typically at the low tax bracket, the business rate, which is, for small businesses, typically about 13%. Starting in 2017, when you sell that, still it's capital gain, but it is now taxed at the higher investment rate, which can be up to 49%. So that is definitely a disadvantage now. The other one here is we have 2 layers of tax. So 2 layers of tax, I say, is when you sell your assets or your corporation is going to pay a level of tax, but also when you eventually need those proceeds out of your corporation as an individual, you got to pull them out. And you need to pull them out typically by way of dividend. You're going to pay a layer of individual tax there as well. So the next slide is selling your business through a share sale. So there's a few more advantages, and they're key advantages. So if you're an individual owning a corporation, you're selling your corporation, capital gains treatment is big. Like I said, 50% of your capital gain is taxable, the other 50% is not. There's also this concept, this tax incentive called the lifetime capital gains exemption. Has everybody heard about that capital gains exemption? It's a big one. We'll talk a little bit more about it. And then the deferral of tax from capital gains reserve. So if you sell your property or you sell your shares and you don't receive all the proceeds in the year that you sell it, there's a possibility that you can actually defer the tax and pay the tax when you actually receive the proceeds from sale. And then one of the big disadvantages, I think, is typically when we see share sales, there's a little bit more due diligence done by the purchaser, so it can be a bit more, take a little bit more time and a little bit more costly. And then I just had some advantages and disadvantages from the purchaser's perspective here, but I'll just quickly go through them. It's really, from a purchaser's perspective, if they're looking, you always hear a purchaser wants to buy assets and they don't want to buy the shares because of the skeletons in the closet type thing, and they want to stay away from that, they don't know the history. And really, there's a lot of ways around that. Like I'm seeing more and more share sales. It's just an easier business transition. You can put things in place to protect the purchaser from a share sale. So if something did happen, maybe the seller is still on the hook for it. But some of the disadvantages too is when a purchaser buys assets, they're looking, they're going to be paying PST and GST on the purchase of that equipment. If they're buying real estate in the business, there's going to be property transfer tax. So there's some other taxes that are attached to the asset and the asset sale, which can be a little bit more taxing and ultimately a little bit more costly for the purchaser. So the next topic is the capital gains exemption. And so the capital gains exemption, like I said, is a big tax incentive for individuals selling shares. And it's about $800,000. It's just over $835,000 now. And it can be used on the sale of qualifying small business corporation shares, qualifying farm property, and fishing property. So we're here to talk about selling your corporation, so that's where we'll talk. So this next slide, as you can see, the capital gains exemption is being indexed. So in 2016, it was $824,000 available. Now it's $835,000. So when you sell your shares, and if you have a capital gain, and that capital gain is about $800,000, it's pretty much a tax-exempt transaction for tax purposes. Anything more than that, you get to use that $835,000 against it. So the important part about the planning, this is really where I want to touch on, is the planning and planning ahead. Because in order for you to take advantage of the capital gains exemption, which is a big component here, there's three basic requirements. One is a 24-month test group. You need to have owned your shares for at least 2 years. So if you buy a business and plan on flipping that business within the 2 years, it's a good chance that the capital gains exemption will not be available to you. There's also this one called the 50% rule. So the 50% rule, it says 2 years prior to you sell, you have to have at least 50% of your value, the assets you own, need to be used to earn active business income. So the capital gains exemption is for businesses that earn active business income. So if you have a business and it's a rental business, let's say, rental business is considered to be passive income, not active income. So that type of business typically will not qualify for this. And then the third rule is saying the 90% rule. And it's saying the day before you sell, you actually have to have 90% of your assets that you're selling have to be used for active business income. So what does that mean? It means that there's some planning that needs to be done. If you own a construction company, for instance, and that construction company has some rental buildings in it, because we see that sometimes, they'll have some commercial rental buildings in there. Then if that value of those commercial rental buildings is greater than 50% 2 years out, that's going to cause a problem if we're selling the business 2 years down the road. If that rental building is actually going to be part of the sale, that's going to be an issue too, because now we're maybe not meeting that 90% test the day before sale. So those are the things that we need to think about. So we talk a little bit about good assets and bad assets as far as the capital gains exemption goes. Scott was telling me if I draw it up on the board, or on the flip chart here, 70% of people will remember it better, so that's what I'll do. And part of my art here. So good, bad. No assets are really bad, but from capital gains exemption we have some. So our accounts receivable, that's a good asset. That's an asset that we would be able to sell. The equipment we use in our operations, another good asset, right? Our prepaid expenses, same thing. And real estate that is used in that business, the active business income, is also a good asset, right? So that's really typically the good side, as well as goodwill. We always have goodwill. So those are the good assets. The ones we need to watch out for is if we've got excess cash, so our business is doing well and we got lots of cash in the bank, we gotta watch out for that. That could throw us offside. Investment portfolios, same thing. That's earning investment income, which is considered to be a passive income source, not an active income source. And then the other one is real estate. So it's on both sides of the board here. But real estate from a rental perspective. So if we're renting our building or renting another building, or we have a number of rental properties in there, we gotta be careful that those types of assets. Just do a quick time check. Okay, we're good. So when we're talking about active business and capital gains exemption, well, how do we use that? How can we take advantage of that? And one of the things here is, this is a typical structure that we'll see where, somebody's just started a company and that company has now grown into a bigger company. We'll say Mr. A here has a family, but Mr. A is the sole owner and operator of the operating company he has. So in this situation, if Mr. A is looking in 2017, says, I'm thinking of retirement 5 years down the road, but right now, I'm wondering what I can do. I got a good successful business. The business is worth $800,000. But I think down the road, 5 years from now, it's going to grow to double that, 1.6 million. So what kind of planning can we do for Mr. A? Well, in this scenario, if Mr. A sold in 2017, he'd be good. He has $800,000 value, let's say an $800,000 capital gain. And in this instance, he would pay really zero tax. But if Mr. A just keeps this structure and 5 years down the road, it sells for 1.6 million, well, he's gonna have 800,000 that's sheltered under the capital gain exemption. But he's also gonna have an $800,000 gain that he's gonna have to pay tax on, which is, ultimately it's probably a pretty good result. He'd probably pay in the neighborhood of $150,000 in tax at the end of the day if he sells his shares. But one of the planning strategies we look at is if Mr. A came in to our office and we said, okay, well, if you think the value of this is going to be double 5 years from now, what kind of planning can we do? Well, Mr. A and Mrs. A Mrs. A doesn't have any involvement, but maybe we can bring Mrs. A in as a shareholder, because every individual owner in Canada has available this $800,000. So we could double the capital gains exemption for Mr. A by using Mrs. A. So one of the structures to do this is we say, in 2017, here you are, Mr. A, we're going to change your corporate structure. We call this an estate freeze. We're going to freeze the value of $800,000, and now that's going to be Mr. A's value. And then we're going to bring in the family trust or other shareholders to be part of the structure. So then 5 years from now, we can use the capital gains exemption of multiple family members. So I tried to draw this last time, it didn't work very well, so we went with this. Got really messy, and I don't know. Nobody knew what was going on. So anyway, so here we are. So what I've got here is I got Mr. A. He's got $800,000 value. What we've done is brought in a family trust. So now we can bring in other shareholders. So we got beneficiaries here, Mr. A, Mrs. A, and maybe there's some children there that we could use the capital gains exemption for as well. The big thing about this is what we've done is we've multiplied the amount of capital gains exemptions. So now we've gone from $800,000 of tax exemption to, let's say, $1.6 million of tax exemption. And that's all with a little bit of planning, right? It costs a few $1,000s in professional fees to put this in place, but 5 years down the road, we probably saved about $150,000 in income taxes in this kind of scenario. So you have a question?
Do they have to bring anything in with them, or can they come in for free?
So they would, in this scenario, what we do is, under an estate freeze, we say the value is $800,000. We actually freeze that value at $800,000, and Mr. A is gonna have shares that are worth $800,000. So on the day that we do that, the company is now worth nothing, because Mr. A has all the value. So the family trust in this scenario would subscribe for new shares for a nominal amount, $100 type thing, $1 per share. So yes, so they pretty much come in for nothing, subscribe for new shares. But down the 5 years from now, that value sits with the family trust, the future value, okay? Any other questions? I'm around after too, if you want to talk a little bit more about that. So that is really what I had to talk about, not too much tax, more about planning and different ideas. So that's where that came from. So I'm going to turn it over now to our next presenter, Kai Schneider. Kai's Senior Account Manager with BDC. He's been with BDC for the last 15 years. He resides in Kamloops, but he helps clients, business clients all throughout the area here, and yeah, with their commercial needs. All right, welcome, Kai.